Taxes? Picture this. You've just finished a brutal month flipping burgers at McDonald's. Payday comes. Your check says $2,000, but when you look at your bank account, only $1,456 made it in. You scroll through the pay stub, federal income tax, state tax, Social Security, Medicare. Welcome to the modern tradition of handing over part of your paycheck to invisible hands. And somehow, you're expected to be grateful. Here's the truth. Taxes are the price of civilization. You pay in, the government builds roads, funds schools, inspects your favorite taco truck for rats, and yes, launches billion-dollar missiles to countries you'll never set foot in. There are different kinds of taxes. Income tax takes a cut of what you earn. Sales tax takes a piece of what you spend. Capital gains tax takes a slice of the money your investments made while you were asleep. On top of that, nearly everyone pays Social Security and Medicare. Social Security is like the government forcing you to put away money for retirement. Pay now, get it back in small doses later. Medicare is a healthcare tax to cover seniors and people with major medical needs. Then comes the dreaded part, filing taxes. The government already knows what you owe, but instead of just telling you, they make you guess. If you're right, fine. If you're wrong, you're toast. Some people pay quarterly, some yearly, and some don't pay at all. And those folks usually end up in documentaries. Annoying? Sure, but taxes also buy a better life. Countries with higher taxes generally enjoy better schools, healthcare, and overall quality of life. Banks. Now let's talk banks. You walk into one, hand the teller your cash, they count it, smile, and say it's added to your account. You leave imagining your money locked in a vault guarded by a dragon. Reality check. It's already gone. Banks aren't giant safes. They're middlemen. When you deposit $1,000, the bank might keep $100 and loan out the other $900 to someone buying a jet ski. That's fractional reserve banking. They only hold a fraction of deposits because not everyone will withdraw at the same time. Unless it's 2008, when everyone did, and the system collapsed. So how do banks make money? By lending your money out at higher interest than they pay you. You're the supply, borrowers are the demand. Why do you even use them? Convenience. Swiping a card is easier than carrying bills. Safety. Better in a bank than in your sock drawer. Insurance. In the US, deposits up to $250,000 per person are government-backed. Even if the bank dies, your money survives.
Interest. Imagine borrowing $1,000 and having to pay back $1,280. That extra $280, interest. It's like rent money pays to live in someone else's pocket. Two main flavors: simple interest, a flat fee; compound interest, interest that earns interest. With debt, compound interest is brutal. Your $12 burrito becomes a $50 regret. But with investing, it's magic. $100 at 7% annual growth doubles, then doubles again and keeps multiplying. That's how ordinary people get wealthy over decades. Rule of thumb, if you're paying interest, kill it fast. If you're earning interest, let it sit and grow.
Inflation. Ever buy a bag of chips that costs 30% more but looks half empty? That's inflation. Money slowly loses value over time. Your $5 bill still says 5 but buys less. Causes: too much money chasing too few goods. Supply chain problems raising production costs. Expectations: if people believe prices will rise, they spend more now, which pushes prices higher. A little inflation, around 2% a year, is healthy. But too much? Savings get crushed, wages fall behind. To fight it, governments often raise interest rates, making borrowing pricier, slowing spending, and cooling the economy. Recessions. A recession is when the economy shrinks for 2 quarters in a row. One moment life's good, jobs secure, bills paid, maybe planning a vacation. Next moment, layoffs, markets crashing, belts tightening. Causes vary. High interest rates, wars, pandemics, financial crises, or just the natural boom-bust cycle. Think of the economy as a party. In the boom, music's blasting and drinks are flowing. But eventually the lights come on and suddenly everyone realizes they're broke. Recessions hurt, but they reset the system. Governments cut rates, pump stimulus, and eventually, spending returns.
Credit scores. Your credit score is a 3-digit number between 300 and 850. Basically, your financial reputation. Below 580, you're a red flag. Above 750, you're golden. It's built on payment history. Did you pay on time? Credit utilization. How much of your limit you use? Age of credit accounts. Mix of credit types. New applications. Treat it like a pet. Ignore it, and it makes a mess. Care for it, and it helps you buy a house. It's less about money itself and more about proving you're trustworthy. Yes, the game's rigged, but if you learn the rules, you can tilt them in your favor.
Currency. Money is a shared illusion. A dollar is worth something only because we collectively agree it is. The same piece of paper could just as easily be worthless without that belief. Governments print it, central banks regulate it, and we trade it. Print too much and inflation eats it alive. Print too little and people can't afford to live. At the end of the day, money works because society trusts it. Investing. To fight inflation, you invest. Instead of your cash sitting idle, you put it to work. Stocks, bonds, funds, real estate, each with its risks and rewards. Wealth doesn't come from luck, but patience. Compound growth over decades is the cheat code. The real risk isn't losing money. It's never investing at all.